Stop what you're doing. If you own even a single ounce of silver or gold, you need to hear this. Right now, while you're watching this, something is happening behind the scenes at coin shops across America. Price boards changing mid-conversation, dealers refusing to buy. And the reason? It's not what you think. It's not demand. It's not hoarding. It's not even the price swings. There's a choke point, one most retail buyers never see. And it's about to collapse the entire system small dealers depend on, which means when you need to sell, the door might already be locked. Welcome to Currency Archive, where we don't just report the news, we warn you before it hits. Now, if you've been in the precious metals game long enough to remember when silver was under 5, when handshake deals still meant something, then do me a favor. Hit that subscribe button, because the insights we share here aren't for gamblers or speculators. They're for strategists like you. And drop a comment. Tell me, where in the world are you watching this from? New York? London? Mumbai? Sydney? I want to see how global this truly is. Now, let's get into what's really happening. The scene playing out across coin shops this week tells a story most people are not equipped to read. A customer walks through the door holding a small collection of silver eagles. The dealer glances at the coins, checks his computer screen, and then does something unusual. He declines the purchase, not because the coins are counterfeit, not because the price is wrong, but because he simply cannot afford to buy them right now. This moment is repeating itself in shops across the country, and the reason has nothing to do with what most people think they understand about supply and demand. The traditional precious metals retail model operates on a principle of constant motion. A dealer buys inventory from the public. He holds it briefly. Then he sells it upstream to a refiner or a wholesaler. The cash returns. The cycle repeats. Speed is everything. The faster inventory moves, the more transactions occur, and the thinner the margins can be while still generating profit. The system has worked for decades, but it contains a hidden dependency that most retail customers never consider. The entire model assumes that refiners will always be ready to receive material. That assumption is now breaking down. Refiners are the invisible backbone of the retail precious metals world. They are the entities that take coins, bars, jewelry, and scrap from dealers and convert it back into standardized product. They provide the exit liquidity that allows small shops to operate. When a dealer buys 100 ounces of random silver from customers on Monday, he needs to know he can send it to a refiner by Friday and have cash back in his account the following week. But something has changed in recent months. Refiners are slowing their intake. Some are requiring larger minimum shipment sizes. Others are extending their processing timelines from 1 week to 4 or even 6 weeks. A few have stopped accepting certain types of material altogether. The cause is not mysterious. Refiners are businesses with their own cost structures and risk management requirements. When silver prices swing violently, refiners face hedging challenges. Every ounce they accept creates exposure until it is processed and sold. In a stable market, this exposure is manageable. In a volatile market, it becomes expensive to hedge and risky to carry. Additionally, refining capacity is not infinite. There are only so many furnaces, so many processing lines, and so many hours in a day. When material flows into refiners faster than they can process it, queues form. And unlike a retail shop that can simply raise prices to slow customer traffic, refiners often work on contracted relationships with preferred clients. The small dealer sending in mixed lots of coins gets pushed to the back of the line. The result is a liquidity trap. Dealers find themselves holding inventory they cannot easily convert back to cash. Their working capital becomes frozen. And when working capital freezes, the entire business model collapses. Consider what this means in practical terms. A coin shop operates on thin margins, often just a few percentage points per transaction. To make those thin margins worthwhile, the shop needs high transaction volume. High volume requires available cash to buy inventory from customers. But if that cash is tied up in silver sitting at a refiner waiting to be processed, the dealer cannot make new purchases. This creates a vicious cycle. The dealer must either stop buying from customers, or he must widen his spreads dramatically to compensate for the capital risk. Both choices reduce his competitiveness. Customers notice when a shop stops buying. They notice when spreads suddenly jump from 3% to 8%, and once they notice, they start looking elsewhere. The cruel irony is that this crisis is intensifying precisely when prices are reaching levels that should theoretically benefit dealers. Higher prices mean larger transaction values and potentially better margins. But those benefits are meaningless if the capital cycle is broken. A dealer cannot profit from high prices if he cannot access the liquidity needed to participate in the market. What makes this situation particularly dangerous is its invisibility to the average customer. When someone walks into a coin shop and sees bare display cases or gets quoted a wide spread, they typically assume the dealer is being greedy or the market is simply volatile. They do not see the refiner relationship breakdown happening behind the scenes. They do not understand that the dealer is not choosing to offer bad prices. He is struggling to survive within a system that has stopped functioning as designed. This is not a temporary disruption. It is a structural shift. And it is selecting against small, independent dealers who lack the capital reserves or refiner relationships to weather extended liquidity delays. The shops that survive will be those with deep pockets or direct institutional connections. Everyone else faces a closing window of viability. The fracture is invisible, but the consequences will be obvious soon enough. There is a building most people will never visit. It sits in an industrial zone, surrounded by security fencing and surveillance cameras. Inside, furnaces run at temperatures exceeding 2,000 degrees. This is where old jewelry becomes new bars, where scratched coins become pure ingots, where the messy reality of the secondary market gets transformed back into standardized product. This building is a refinery, and right now it is the single point of failure destroying coin shops across America. Understanding what happens inside these facilities requires abandoning their romantic notion of precious metals trading. There is no drama here, no excitement, just industrial chemistry, risk management spreadsheets, and profit margin calculations measured in fractions of a percent. But those boring details are currently reshaping the entire retail landscape in ways most market participants cannot see. A refiner's business model is deceptively simple. Accept material from dealers, process it into standardized form, sell the refined product to manufacturers, mints, or institutional buyers, extract a processing fee from the spread between intake price and output price. The profit exists in volume and efficiency, not in speculation or market timing. But this model contains an embedded vulnerability. The moment a refiner accepts material, he owns price risk. If silver is trading at $32 when he receives a shipment, but drops to $30 before he finishes processing and sells the refined product, he absorbs that loss. In stable markets, this risk is negligible. Prices move slowly enough that standard hedging strategies work reliably. The current market is not stable. When silver moved from $31 to $34 and back to $32 within a single week in mid-January, refiners faced a hedging nightmare. Traditional futures contracts become expensive when volatility spikes. Options premiums rise. The cost of protecting against price movement starts eating into profit margins that were already thin. Refiners responded the way any rational business would respond. They began managing their intake more carefully. Instead of accepting every shipment that arrived, they started prioritizing material from large, trusted clients who send consistent volumes. They raised minimum shipment sizes to reduce the number of small, inefficient lots they needed to process. And they extended their quoted processing times to give themselves more flexibility in managing price exposure. From the refiner's perspective, this is sound risk management. From the small dealer's perspective, it is a catastrophe. Consider the mathematics. A typical coin shop might accumulate 15 to 20 ounces of mixed silver product per week from customer purchases. Under the old system, the dealer could ship that material every Friday and receive payment the following Wednesday. Working capital turned over weekly, cash flowed consistently. Now, the refiner requires a 50-ounce minimum shipment. The dealer must accumulate inventory for 3 to 4 weeks before he can ship anything. And when he finally sends that shipment, the refiner quotes a 4-week processing timeline instead of 1 week. What used to be a 7-day capital cycle has become a 7-week capital cycle. The impact on cash flow is devastating. A dealer who previously operated on $10,000 in working capital now needs $50,000 to maintain the same transaction volume. Most small shops do not have access to that kind of capital. And even if they did, the extended timelines create enormous price risk. What if silver drops $5 during those 7 weeks? The dealer's entire margin disappears. There's another factor intensifying the bottleneck. Refiners are becoming more selective about material quality. In high-volume, stable markets, refiners accepted almost anything. Jewelry with stones still attached, coins with dirt and corrosion, mixed lots of various purities. Processing these inefficient materials is worthwhile when throughput is the priority. But when refiner capacity becomes constrained, quality sorting begins. Material that requires extra handling, additional cleaning, or complex separation processes gets pushed to the back of the queue or rejected entirely. Refiners prefer clean, standardized material they can process quickly. The random assortment of scrap and secondary market coins that small dealers typically accumulate becomes less desirable. Geography compounds the problem. Refining capacity is not evenly distributed. Some regions have multiple refiners competing for business. Others have only 1 or 2 within practical shipping distance. Over the past decade, consolidation reduced the total number of independent refiners operating in the United States. Smaller facilities closed or were acquired by larger operations. This consolidation seemed harmless when capacity exceeded demand. But now that demand is pushing against capacity limits, dealers in regions with limited refiner access find themselves with almost no options. They cannot simply switch to a different refiner when their primary relationship deteriorates. There is no backup plan. Regulatory requirements add another layer of friction. Anti-money laundering rules require detailed documentation of material sources. Each shipment needs paperwork. Each transaction creates compliance obligations. For large, institutional shipments, these requirements represent a minor administrative burden. For small dealer lots, the documentation overhead becomes disproportionate to the transaction value. Refiners are businesses, not charities. When processing a $5,000 shipment requires the same compliance work as processing a $50,000 shipment, the economic choice is obvious. Serve the larger clients. Let the small dealers wait. The mechanism is now clear. Refiner constraints have transformed price volatility from a manageable trading challenge into an existential liquidity crisis for small operations. The invisible bottleneck is tightening, and dealers are suffocating. There is a moment in every failing business when the owner realizes the math no longer works. It happens quietly, usually late at night while reviewing spreadsheets. The revenue columns still show activity. The inventory still has value. But the timing is wrong. Cash comes in too slowly. Bills arrive too quickly. And somewhere between those two timelines, the business suffocates. That moment is arriving simultaneously at coin shops across the country. Not because owners made bad decisions, not because customers disappeared, but because the underlying infrastructure they depend on has shifted beneath them, and the business model that worked for decades has suddenly become unworkable. The traditional dealer cash cycle operates like a heartbeat. Money flows out to purchase inventory. Inventory sits briefly on the shelf or in the safe. Then inventory converts back to cash through wholesale liquidation. The cycle repeats. Each complete cycle generates a small profit. Success comes from completing many cycles quickly, not from making large profits on individual transactions. Speed is everything. A dealer who completes 50 cycles per year operating on $5,000 in capital generates more profit than a dealer who completes 10 cycles per year operating on $25,000 in capital. The mathematics favor velocity over volume, but velocity requires reliable exit liquidity, and exit liquidity now moves in slow motion. When a refiner extends processing times from 1 week to 6 weeks, the dealer's capital cycle does not just slow down. It multiplies by a factor of 6. A business that previously required $10,000 in working capital to maintain operations now requires $60,000 to sustain the same transaction volume. Most small shops do not have access to that capital. They cannot borrow it. They cannot raise it from investors. They simply do not have it. The immediate effect is purchasing paralysis. Dealers must become dramatically more selective about what they buy from customers. That Silver Eagle collection worth $800? The dealer wants to buy it. His customer wants to sell it. But he cannot commit $800 knowing that money will be locked up for 6 weeks with no guarantee of what silver prices will be when his refiner finally processes the material, so he declines the purchase. Or he quotes a spread so wide that the customer walks away offended. Either outcome damages the business. Declining purchases means lost revenue and disappointed customers who remember the rejection. Quoting wide spreads drives customers to competitors or alternative selling channels. Both choices accelerate decline, but there is a deeper problem. Customer behavior shifts when they sense dealer weakness. Experienced precious metals buyers understand market dynamics. They recognize when a dealer is desperate or constrained, and they adjust their negotiating behavior accordingly. A customer who previously accepted a dealer's quoted price without argument now pushes for better terms. A seller who once took the first offer now threatens to go elsewhere unless the spread narrows. This creates a perverse dynamic. The dealers most constrained by refiner liquidity problems are the ones facing the most aggressive customer pressure. Their weakest moment becomes the moment when they need pricing power most, and they do not have it. Inventory management becomes impossible. The traditional approach was simple. Buy anything reasonably priced. Sell everything quickly. Maintain minimal on-hand inventory to reduce capital lockup and security risk. But when exit liquidity slows, dealers must hold inventory longer. And longer holding periods mean greater price exposure. A dealer who bought silver at $33, expecting to ship it within a week, faces minimal risk. Even if prices drop to $32 before he ships, the loss is manageable. But a dealer holding that same material for 6 weeks while waiting for refiner processing faces catastrophic risk if prices drop to $28 during that period. His entire margin evaporates. He may even operate at a loss. Risk management strategy suggests buying less inventory to minimize exposure, but buying less inventory means fewer transactions and lower revenue. The dealer faces an impossible choice: accept enormous price risk or accept revenue collapse. Neither option leads to survival. Geographic factors intensify the cascade. Markets with multiple competing dealers see the weakest operations fail first. But their failure does not strengthen the survivors. It signals to customers that the market is unstable. Trust erodes. People begin questioning whether any dealer is reliable. The failure of one shop casts doubt on all shops. In markets with only one or two dealers, the effect is different but equally destructive. When the primary dealer becomes constrained, customers have nowhere else to turn locally. They shift to online platforms, direct refiner relationships, or simply stop transacting. The local market does not collapse dramatically. It evaporates gradually as participants find alternative channels. There's also a competitive displacement effect that rarely gets discussed. Larger dealers with direct refiner relationships or their own processing capabilities do not face the same constraints as small shops. They can offer better prices because their capital cycles remain fast. They can buy more aggressively because they have access to liquidity that small dealers lack. This creates a selection pressure. The market is actively sorting dealers by size and access to capital. Small, independent operations cannot compete on pricing. They cannot compete on inventory availability. They cannot compete on transaction speed. Their only competitive advantage, personal relationships and local convenience, becomes insufficient when the price gap widens too far. The mathematics are brutal. A small dealer offering a 4% spread cannot compete with a large dealer offering a 2% spread. Customers tolerate some price difference for convenience, but when the gap doubles, loyalty disappears. Authentication and testing services face similar pressure. Many coin shops provide free testing and verification for customers deciding whether to buy or sell. This service builds trust and drives transaction volume. But when dealers become capital constrained, they cannot afford to provide free services. They start charging fees, and customers resent paying for something they previously received free. The entire value proposition of the local coin shop is decomposing. Fast transactions become slow. Competitive pricing becomes expensive. Free services become paid. The reasons customers chose local dealers over online alternatives are disappearing one by one. This is not a market correction. It is infrastructure collapse. And the collapse is accelerating. There is a principle in systems analysis that most people find uncomfortable. When infrastructure fails, it does not repair itself by waiting. The system reorganizes around the failure point. New structures emerge. Old participants disappear. And the people who believed things would return to normal discover that normal no longer exists. The precious metals retail infrastructure is reorganizing right now. The changes are not temporary, they are permanent. And participants who fail to recognize this reality will find themselves on the wrong side of a market that no longer accommodates their assumptions. For individuals looking to sell precious metals, the implications are immediate and unfavorable. The competitive landscape that once provided multiple buying options is contracting. Fewer dealers means less competition for customer business. Less competition means worse pricing. The seller who could previously visit 3 shops and negotiate the best spread now finds only one shop willing to buy, and that shop knows it. The pricing dynamic shifts from competitive to extractive. When a dealer operates in a market with 5 competitors, he must offer reasonable spreads to retain customers. When he operates as one of 2 remaining buyers, he can widen spreads significantly without losing business. Customers have nowhere else to go. The dealer's constraint becomes the customer's cost. Liquidity itself becomes conditional rather than guaranteed. The assumption that precious metals can be sold quickly at something close to spot price is breaking down. Sellers increasingly face situations where dealers will buy, but only at specific times, only in specific quantities, or only at spreads that feel punitive. The promise of precious metals as liquid assets is being tested. The test results are concerning. Transaction settlement introduces new uncertainty. When dealers operate under capital stress, payment timing becomes less reliable. A seller who expects immediate payment might receive a check dated 2 weeks forward, or payment contingent on the dealer's refiner completing processing. These delays transform what should be a clean transaction into an extended exposure to counterparty risk. The trust required for these transactions erodes when dealers show signs of financial strain. A customer watching a shop reduce inventory, widen spreads, and slow payments begins questioning whether that dealer will exist next month. And once that question enters the customer's mind, the relationship changes. People stop bringing their best material to dealers they do not fully trust. They hold back. They wait. They explore alternatives. For buyers, the implications are different but equally significant. Premium structures are shifting permanently. The tight spreads that existed when dealer competition was intense and capital cycles were fast are not returning. Even after refiner constraints eventually ease, the reduced number of surviving dealers means less competitive pressure on pricing. Premiums will stabilize at higher levels than buyers experienced in previous years. Product availability becomes inconsistent. Dealers cannot maintain deep inventory when their capital is constrained and their exit liquidity is uncertain. The buyer looking for specific products in specific quantities will increasingly face back orders, substitutions, or simply unavailability. The convenience of walking into a shop and purchasing exactly what is desired becomes a luxury rather than an expectation. Authentication and verification services will carry costs that previously did not exist. As dealers face margin pressure, free services disappear. The customer who wants coins tested before purchase should expect to pay for that service. The casual browser who wants to examine inventory without commitment will find dealers less accommodating. Every interaction that does not generate revenue becomes something dealers can no longer afford to provide. The consolidation outcome appears inevitable. Markets will reorganize around fewer, larger dealers who have sufficient capital and refiner access to survive the current environment. These surviving dealers will operate with greater pricing power and reduced customer service expectations. The personal relationships and accommodating service that characterized small independent shops will be replaced by standardized policies and take-it-or-leave-it pricing. This consolidation creates institutional arbitrage opportunities that bypass retail infrastructure entirely. Sophisticated buyers and sellers with sufficient volume increasingly work directly with refiners or wholesalers. They avoid retail spreads altogether. This trend accelerates as retail spreads widen and retail service quality declines. The retail channel becomes reserved for small transactions and unsophisticated participants, while informed players move to direct institutional relationships. The verification problem intensifies as shops close. Precious metals require expertise to authenticate. Counterfeit detection, purity testing, and product knowledge exist primarily at the dealer level. When dealers disappear, that expertise disappears with them. Buyers lose access to trusted verification services. Sellers lose access to knowledgeable evaluators. The market becomes more opaque and more vulnerable to fraud. Premium volatility becomes a permanent feature rather than a temporary condition. When dealer inventory is thin and capital cycles are slow, premiums react more dramatically to demand shifts. A modest increase in buying interest can spike premiums sharply because dealers cannot quickly acquire inventory to meet demand. A modest decrease in buying interest has the opposite effect. The stability that came from dealers buffering supply and demand fluctuations diminishes. There's also a geographic dimension that deserves attention. Urban markets with higher population density will likely retain some dealer presence. Rural and suburban markets may lose local access entirely. The convenience of local transactions disappears for many participants. They must either accept the costs and delays of shipping material to distant buyers or exit the market altogether. For those currently holding precious metals as part of a long-term strategy, the message is clear. Liquidity assumptions need revision. The belief that precious metals can be quickly converted to cash at reasonable prices is no longer universally true. Liquidity now depends on timing, location, quantity, and the specific condition of dealer networks in each market. Strategic positioning requires recognizing that the retail infrastructure is not temporarily disrupted. It is permanently restructured. The participants who adapt their behavior to this new reality will navigate it successfully. Those who wait for a return to previous conditions will find themselves operating on assumptions that no longer match reality. The market is not broken, it is reorganizing. And reorganization always creates winners and losers. The difference between those categories depends entirely on whether participants recognize what is actually happening and adjust accordingly. The invisible fracture has become a visible transformation. The question now is who adapts and who does not.